Good morning, everybody. Welcome to the Flow Show. Friday. Here we are, nearly the weekend. Looking forward to it. Good morning, Kay. You got one eye on the pub already?
Good morning, Ryan. Good morning, everybody. TGIF. No, I'm still waiting to see what the day will bring today before really starting the weekend. I haven't even put my wine in the fridge yet, so but a good reminder. Thank you.
I'm going to call you a liar. Us traders who've been in this game long enough, we have our eye on the pub, whether it's Monday, Tuesday, Wednesday, Thursday, or Friday. So yeah, I'm calling you out on that one, mate.
Every day that ends in day.
Exactly.
You're not sharing, by the way.
I'm not sharing. Why aren't I sharing?
Not sharing your screen.
Right out loud. Oh, it's Friday. I'm having one of those Friday moments. There we go. Are we all sharing?
Lovely.
Good. Right, let's get into it then. Lots to talk about in Japan as normal. But we'll start with China, where they kept the 1-year MLF rate, the medium lending facility or median lending term facility, interest rate unchanged at 2.5%, largely as expected. But they did stop their cash injections under the MLF, which is the first time they've done that since November 2022, apparently. So for some reason, they felt no need to add some liquidity at this stage. Right, over in Japan, we've had a bit of the icing on the cake regarding the wages. We've had all the Rengo news out. They say that annual wage hikes have hit 5.28%, and that's versus the 3.8% last year. They say base pay is to rise 3.7% versus an initial 2.33% last year. They say that the fiscal year 2024 pay increases are the largest in more than 30 years. They say Japan is at a critical stage in a shift towards an economic revival, and that the wages must spread to the wage growth of small firms and non-unionized workers. They also say that part-time wages hikes reached 6% for 2024. Now, Rengo is the largest union, but unlike UA Zenzen, who covers the majority of the industry side of things, these boys cover a bit more wider scope for that. So, on the whole, I think from what I've been reading, the annual wage hike at 5.28% is a little bit below what we might have been expecting, but it's just part of the pot. And it should be remembered, this is just the first round of talks, so things can get negotiated, renegotiated in the future talks that will come over the next few weeks. But it all seems to be going well. Anything in those wage numbers you've seen that is troubling or positive, Kay?
No, I think it's overall positive, right? We are well above the last year's pay hikes. This is going to be going to need a propeller head to find really whether they are going to where the real wages are going to end up. But if you take it as a whole, Rengo being the confirmation, it's looking good for the wages at least. So on that front, I think it's a pretty decent victory for the workers.
Yeah.
But then we're looking at the end reaction. Well, the end reaction. I've heard there's a bit of unwinding going on of people who were front running the whole thing, and that's why we are back here. But it doesn't make our job much easier. I think we really now need to wait for the Bank of Japan to tell us what they really want to do, and then the reaction on the JGBs, and then the reaction from what the Japanese whales are going to do, and that's really going to be much more important for future yen moves, right?
Yeah, exactly.
But this wage round, Kishida was also very upbeat about it. Suzuki, I think, as well. So it's all pointing at them being able to move. Now, the big question remains: what are they going to do next week?
Yeah, exactly. Well, I was going to come on that because GG have obviously become the mouthpiece of the BOJ because they're dropping, several stories a day now. But the market is largely ignoring it at the moment. It's overkill on headlines. Yesterday, one of the pieces was saying that the BOJ is arranging to end its negative interest rate policy at the March meeting. Then this morning, after we got all those Rengo headlines, they dropped another piece saying that the BOJ are making final arrangements to end negative rates next week. So it's potentially looking like we could get something, or they could move at next week's meeting, which again, from a risk point of view, will make the bigger price move. If they don't do anything at next meeting, you're going to get a reaction to that. But we seem to be there or thereabouts. 12 out of 34 economists, though, polled by Reuters, only expect them to end next week. 21, so just 2/3, still think it's going to be April. So maybe there is a little bit of room there in market expectations for a price move when it happens in March. But again, I still think we're going to get a confirmation move. But again, I can't see it being big. I can't see a big downside move coming if they suddenly decide to go, unless it's a real hawkish turn. If it's just we're going to zero with rates, we're going to end YCC. There's a long road to go. We're going to keep easing, going to keep bond buying, going to keep an eye on yields and all that sort of stuff. If the culmination is a 10 pip hike and we're going to have to wait 6 months until we decide what we're going to do next, I think the markets might be a bit disappointed with that, and we're going to see the buy room, a sell fact trade play off.
Yeah, it's going to be about what they do and what the communication is about it. And there's various things they can do, as you just already said about the YCC. They can officially stop ETF buying, or they can stop the rule that they use to buy ETF. And perhaps they are going to leave the door open there, because they will not want the Japanese market to derail. That's for sure. And because from day one, we know that actually when the government and Ueda said that they would work closely together, let's not forget that there's a lot of stimulus packages to be funded still. Some of them are rolling off, but the exceptional ones. But there's a lot to be funded still. So Ueda will make sure that he doesn't let derail the market. Now, but there's a lot of numbers as well to come, numbers meaning that are they going to completely abandon YCC, or are they just going to keep the loose band somewhere in place? As you said, the JGB buying, for the time being, the rumors are that they are going to buy 6 trillion per month, which is actually not that much, because it would only cover the maturities that are going to come into the next fiscal year. So I think if they officialize the 6 trillion yen and that's it, that may already cause a reaction in the yen, because the JGB market is probably going to sell off a little bit on that. Now, if he comes and he says like, well, we are going to buy as much, and then we are going to buy more if we come to the extremes of what we think, that should be a calming effect have a calming effect in the JGB market. So it's going to be case of putting it all in one pot and then decide on whether and that's going to be the big driver, whether the JGB market how the JGB market is going to react. Okay, and then deriving from there, if and when the Japanese whales, the insurers, are potentially going to repatriate money and go back more into local assets, as they have been saying. Okay, they have been saying this. They said like at certain levels they would start to up their JGB buying again. Whether it would be 10 years or 20 years, that is left in the middle still for now. But the biggest market will of course be the 10 years somewhere. So there's
very much.
Still a lot of moving parts in there. And then, of course, what Ueda will say about the future path of hiking. He has been a bit of a communicator, right? As I call him, he's not being the big reformer, but he is the big communicator compared to Kuroda. He's talking a lot more. And of what I understand, Gigi is kind of now the mouthpiece of what they want to send into the markets compared to what it was before. We had the Nikkei. We had even before with Kuroda, we had the Mainichi at one stage. A small one, but sending out some messages from time to time. But yeah, there's still a lot that can happen, and then when are those Japanese whales going to move? For the time being, as Mark was also mentioning in our room earlier today, it's more a case of the Westerners trying to figure out what's going on in Japan, right?
Yeah, exactly. But I think I think that's going to be the case, that where they'll remove tools but not remove the ability to use them again. Like we're going to stop YCC, but if we see bond markets becoming dysfunctional, we'll step in for unlimited amounts again. So they'll put the tools in the box, but they won't seal it up with duct tape just yet. I don't think.
Yeah, I agree.
But anyway, yeah, so just moving on, as Kay mentioned, Suzuki was out saying he's seeing strong pay hike moves in wage talks. They're closely watching the wage trends, expects the strong wage move to spread to smaller firms. And then he said Japan is not experiencing deflation. Not quite saying it's the end of deflation, but they're not experiencing any, which really has been the case for a while anyway, real deflation. Kishida said that wage increases are flowing strongly and seeing positive trends in personal consumption. It's a bit weird that his approval rating goes down while everyone's getting pay rises. You'd think people would be a bit happy, but that's
but there's still those problems that they had last year with members from the party, right? But let's face it, the opposition is still not ready to take over there. They are still very diverse and not really managing to put one serious candidate in front of the LDP. So I think there's a lot of and also, you know, I mean, it's the newer generation is and we see that a bit globally, right? Is a bit of a it's becoming a little bit more westernized, so that is like basically be against the establishment in place. There's a little bit of that in there as well.
Could he call and if let's all these wages go through, the Bank of Japan normalise, the economy picks up a bit in second quarter, third quarter, everything's looking rosy. Do you think he'd use that to call an election?
Well, there is no set date, but they have to do it. There will be the next general election is I think end of next year or so. But there is no fixed date. They can schedule it. They can if he finds a bit of mojo, he can decide. All right, let's dismantle the diet and let's go to the polls. He could decide it, but I think he's still cleaning up his party, and we've seen quite a few members being thrown out, other ones being brought in, and perhaps he still needs a bit of time. But I think it's possible if we see a positive effect. Let's say start second quarter of the fiscal year, so that is June, July. He may decide to do it. They like to do it somewhere over the summer months sometimes to announce early elections. But for the time being, I'm not sure it's an immediate thing, you know.
Cool, thanks, mate. Right, so moving on from those expectations of what economists think for the BOJ. A similar poll for the BOE has popped up, and economists there think that they've keep their view unchanged. They see 50 pips of cuts for the BOE to 4.75 in Q3. That was the same as the February poll. However, 40% now saying that the first cut will come in Q2, so it's narrowing a little bit there over when the first cuts to come. ECB's Lane says that we need to take our time to get rate cuts right. He's speaking again today, I think. ECB's not. Expects the first rate cut to come in June. That's where he's sticking his flag. Further rate cuts this year, most likely in September and December. But the decisions in SEP and DEC would be helped by new projections and data. Interim meetings would also be available for rate cuts if incoming data tells us we should do more. So keeping the door open, opening the windows as well. Nothing's out for ECB's not. De Guindos says he sees the economy picking up in the second half of 2024. Again, he's putting himself in the June camp, saying we will have sufficient level of info in June to make a decision. ECB's Stornoas, who's gone to the top of the Dove list, says a soft landing has been achieved. Ollie Ren, inflation is set to enable easing near the summer. Wojcik, we need to see labour market data before acting. Over to some of the data. We'll look at yesterday's stuff in a moment, but we had some final bits and bobs in CPI coming through this morning. Final numbers from France, as you can see there. Just a little bit hotter. CPI coming in a pip hotter than the flash. The Eurozone measure as well coming in a pip hotter. So stickiness remains there in France. Italy numbers as well coming in. CPI bang on the money, 0.8%. The HRCP number down a pip there, 0.9%. But as you can see the difference just between two countries, 0 points for Italy, 3s, 2s for France. So still a wide spread going on in the Eurozone. Let's go back to yesterday's data while we're here. So differing numbers coming out. I'll go through it bits and pieces. Firstly, jobless claims, that went back to no worries going on there. The continued claim number moving back into the 1.8 million after its little wander into the 1.9s. Prior month got, or prior week got revised down as well. Headline 209k, all tickety boo, nothing going on there. Move along. Retail sales. This is one of those ones where it depends. You can read it how you want to read it. Retail sales were higher, missed expectations, but the headline was higher, so turned around the loss from last month. But then it starts to look a little bit weaker when you strip out the bits and bobs. For example, ex-gas and autos only 0.3%, which was what was expected. Then if you look at the core sales, they came in flat. So that's taken out all the gas, energy, all that sort of stuff. Leaves a flat number. So not that good a number there. PPI, though, that played into the inflationary stickiness we're seeing with rising more than expected. Quite strong monthly numbers, fairly strong year-on-year numbers as well. Core PPI, as you can see there, beating expectations, matching last month, month on month, coming in better than expected or higher than expected. And as you can say, the PPI there as well. And although I was out, that looked okay to be the main driver yesterday of the dollar. It sort of overtook what we saw from the retails numbers.
Yeah, we had exactly the same reaction as we had before. Like dollar got sold on a rally, and then we came back to the higher levels, and then all of a sudden, people started to realize probably the PPI data, the claims perhaps still doing okay, and then gradually the US yield started to move higher, and that was enough to finally turn around the ship. But and it's been a decent move. Not only if you look at the euro dollar is always going to be the slower one with those FX vols, but if you look at stuff like Aussie, Kiwi, Cable, they all gave it up, you know. And now we are back to levels from where this or closer to the levels from where this dollar little sell-off began. But okay, this afternoon we're gonna have another set of data. Again, as I was saying, joking about yesterday, the New York Empire State Manufacturing could come in anywhere between -25 and +30. But then you have the capacity utilization, the IP, and then the Michigan, right? And I guess the market is waiting for to see what to do with the US yields. But it's we are still, and we've been saying that for ages, we're still in a yields game. Yeah, when the dollar yields go up, the equity market has come off a little bit from its highs as well, and that was enough to underpin the dollar then. And send risk a tad lower, except versus stuff like Swiss and yen. They are still in their world apart. We cannot just judge a market now by looking at yen or Swiss, right? We need to look at other stuff because yen and Swiss live their own lives for now, especially with the Swiss as well, with SMB next week. But yeah, I think also, Ryan, what I think is positioning. The market has been selling dollars. The market has been looking at the seasonalities. The market has seen that most of the currencies are doing very well, starting the second half of March versus the dollar, and probably people already front running the stuff, and that's a little bit like the yen as well. You front run what's coming, and then all of a sudden you find yourself in a position where if some of the flows come in the market and say like, well, we actually need a few dollars here, you're finding yourself in a little bit of trouble. And that is exactly, I think, what is happening right now. And somewhere I would say ball back in the middle, and we kick off again for the next set of data.
Yeah, exactly. And it should be noted also we're probably in Fed orbit as well for next week. So, the market looking at other banks like, the Fed, we've got the BOJ to happen as well. But the Fed is going to be the big story. These inflation numbers, how's Powell going to sell that again? Is the markets, as Kay said, we've seen a decent sell-off in the dollar, but with some of this data, is it going to cause the Powell to be a bit more on the hawkish note? It will be a bit more guarded on when cuts are going to come because we're still playing that game. So I think, maybe a little bit of that coming in as well. The closer we get to a Fed, the closer or the more the market tends to look at that side of the trade rather than everything else. But it's another big week next week. RBA's next week as well, isn't it? BOJ, RBA.
It's
DOE as well. So
we're in a big central bank week, Ryan. Next week, as you say, there's a lot going on. You got the Fed, you got the Bank of England, you got the RBA, you got the Bank of Japan, you got the Norges Bank, you got the SMB. It's a real festival again.
Yep, there we go. There's the there's the list that we've got. So we've got 1, 2, 3, 4, 5, 6, 7.
Oh, and Mexico.
Mexico, 7 next week. Well, 7 in the space of 2 days, 3 days. So, I thought we had a busy week last week. Now we've got another busy week to look forward to next week. Oh dear me, you're going to have to ship some coffee in again. But yeah, it's going to be a big old week again for the central bank. So a lot of the market is going to be keeping an eye on these. Obviously some like the RBA aren't. There's not much expected from them. Obviously the big one's going to be the Fed. Bigger one's going to be the Bank of Japan. Bank of England should be a bit of a nothing burger meeting, but the market will be looking at that for signs of when the BOE might start to think about cuts. And then obviously the SMB, they're only quarterly. So, you have to they have to pack a lot into one meeting because we won't hear from them again for 3 months bar the speakers that come waffling out. Right, let's just finish off the old headlines and stuff. A couple of bits and pieces. Hapag-Lloyd CEO says the market is getting calmer and spot rates are coming down. This is obviously from the fallout from the Red Sea stuff and shippers having to go the long way around to avoid the Red Sea. But that seems to be settling in prices. A few ECB members and the like mentioning the impact from higher shipping costs in inflation as a temporary possible spike to inflation or injection to inflation there, but those spot rates are coming down. Over in the UK, the Telegraph reporting that apparently cabinet ministers, so those around Sunak, are holding talks over replacing him before the next general election. And on that election, yesterday, Sunak ruled out the possibility of an election happening on the 2nd of May. So we're still playing the guessing games there. And one other headline, which I'll let Kay delve into, it's something that's coming up. We're going to need to be aware of it. I don't know if it's another 2K moment or it is going to be something that we need to worry about. But the deadline for the moving to T1 in FX is getting closer. And there was a Bloomberg piece saying it's going to become a 70 billion day of risk for currency markets. That sounds like a typical Bloomberg headline. Kay, what's going on? Should we be worried? And yeah, do I need to go and live in Dale's bunker for a week?
Well, the funds over in Europe, and we heard from those before in Asia, are worried that they won't make the deadlines for the payments in New York. So we're just having a laugh about it as well in our room.
Do you want to give just a quick brief on what it actually is, just for those who may not know?
Okay, so in April, and now in April, the settlement date for equity markets and stock trading is moving from 2 days value date to 1 day value date, the settlement day. Okay, so just like a little bit in the funds, dollar Canada is already there, right? You settle the next day instead of settling 2 days later. But that means that is it May, Mark? I thought it was already coming in April. It could be May. Okay, regardless of whether it's May or April, it's coming close. Cheers, mate. Yeah, Memorial Day weekend. So it's coming closer anyway. But then, so we heard Asian payment systems and funds already complaining because that reduces their window for payments, especially when they do overnights and stuff like that, to really a few hours only, or even outside their own hours. And now the European asset managers are also NCLS, which is the payment system that's used. They are also panicking, saying that it narrows the payments settlements window, and they may not be able to settle everything within that window. Now the thing is, they knew that from last year, and it seems that they just I mean have not accelerated the automation of payment systems. Okay, there will always perhaps be a bit of an issue with the width of the pipes. I don't know, but systems like that, they should really be ready. But it's a bit panic stations now. What it may mean, it's of course it could work on both ways depending on the assets, right? But what it may mean, if you need, for instance, funding for doing trades, yeah, you need funding for buying US assets, for instance, you will have a day less to pay them, which could end up, and that's what those asset managers are hinting at here in Europe and over in Asia. It could make markets become a little more erratic around closing times or the hour before closing time in New York, for instance, when they are going to be in a rush for either funding in dollars or doing the other side. So they are well, first, there's two problems there. It's the window for payments, which is a technical issue, and then it's the funding issue, because they will have a day less to fund their operations, and that is now causing a little bit of panic. So what that means for us is that we could see if they don't get a delay, or if FX doesn't get a delay, could mean that we have a lot more volatility, whether it be in equity markets or in the short end, at least, of the bond market, because the funding is usually done in the really short end, right? It's not like the 5, 7, 10, 20 years or so.
Yeah.
It's the short end. And so there could be a lot more volatility if they really have to go to market a lot faster. So less smooth operations. That's basically it, and in my opinion, of what I know about it.
Yeah, thanks, Kay. Ali, what will happen when you trade dollar CAD?
Nothing.
For your trade,
Nothing. That's
nothing.
already there.
Yeah, but
You're
it
already
just
trading
might
T plus one.
it might mean that we see general more volatility in markets when people have to settle. It's effectively like, let's say you're buying a house in Canada, Ali. So you're going to sell dollars and you're going to buy Canadian dollars. Well, you do that now, and that settles in 2 days or 1 day time in terms of dollar CAD. So in that 1 day ahead, you get your CAD and you hand over your dollars. That's the physical transaction that takes place. But everything else, it's 2 days. So all it's saying is people are going to lose a day in being able to get their money together to do those transactions. And that's if systems aren't ready and whatnot, then you're going to have potentially times where people haven't paid what they need to pay nor received what they need to receive. And then you find that there's all funky stuff going on. So that's how it works. So for us traders, it's potential volatility. But as for you, buying or selling your CFDs and whatever, it's not going to make that much difference anyway. Right, Daniel, thanks, Kay, for that. We'll obviously keep an eye on that and the headlines as it comes through to see whether we need to take more note of it. That's all I've got on the news front. Anything else, Kay?
No.
Good. I always like it when you say no. Right, let's have a look at stuff. What's going on? So, yeah, we'll start with bonds as I was sitting here anyway. So we're back above 420 on the 10s, hence why the dollar's finding a little bit of a bid. Again, is this significant? We were getting decent enough data and this was coming down. Well, we're getting a few odd weak bits of data when this was coming down. Now we're going the other way. Again, I can't see us doing much. This is probably just some Fed readjustment going on, like we've seen in twos, lining up more where the dots are for the Fed. So we're probably doing a bit of Fed trading at the moment on this one. Euro dollar, it was sitting up. We were joking in the chat room for the last few days, or pretty much all week. It was either trading 109.30s or 109.40s, and then 109.30s again and 109.40s. Well, dollar strength came in on the back of that stuff yesterday. We've had a move down, and look where we found support, right bang on my old zone. This zone goes back years, even further than 2015. This zone, hence why I've always got it on my chart. And when we've been wandering away for it for a while, we come back and wallop it support, and it's support for the second time as well. So it keeps the trend alive that we've had since mid-Feb. So we're not breaking down that at the moment. I haven't got a fib there because I don't tend to have such short-term fibs, but that looks to be roughly around the 38.2-ish. If I was to stick one on there, it won't be that far away. So the question now is, what do we do on the rest of the data? Are we going to see a little bit more dollar strength coming in? I think the Michigan's going to probably be the bigger number today because it's a consumer survey. It's the flash number. And as we are a few days from the Fed, it can be a funny one. If there's more stuff going on elsewhere, the market can ignore it. But I think, as I say, close to the Fed next week and what we've seen so far, there's probably going to be a few eyeballs on this one if there's a big variation. Obviously, looking at the inflation numbers that come with that as well. Let's just take it down to it. Where are we? Down here. So keep an eye on these. There's no expectations on this one, but on the calendar I use, the 1 year is expected to come in at 3.1%. So higher than last month by a pip. The 5 years expected unchanged at 2.9%. So it'll be headline and then probably these inflation numbers that are going to move markets. Again, important because it's the Fed next week. So we get a big jump in these inflation numbers. The market's going to get a bit hawkish over what Powell may say next week. Some of the other pairs, look at cable. Doesn't seem to be doing as bad. Obviously, we had that reach up towards 129, so we're off a bit. But given where we've been over the last week or so, it does look softer. We're below 128. We're just below these series of highs, 70s, 80s. So that's probably your watch point this morning. If we hold on rallies below that, 70s, 80s, that might just be changing the picture a little bit we might just be looking at a little bit more of a bearish phase. But you can see it's all about the dollar, because euro sterling is doing nothing still. So that's your key there. Now, Kay, I want to speak to you about the crosses here in the yen, because, you know, dollar yen's obviously on its grind up, doing one of its grinding things, but the crosses have been a bit more mixed. It reacted a bit to the Japanese headlines. Now it's coming back a bit. So it looked a bit dollar move at one point. Now it's a bit yen move. What do you make of what's going on in the crosses? Are we trading yen here, or are we just following what else is going on?
We're trading yen. And that's what I thought, as far as what I said before. Market is expecting something front running the whole thing, and then you find yourself starting to pay carry, to pay funding, and finding yourself not looking in a hole, because I guess some have made decent money on the move down in yen pairs, but I think the faster movers, they've also said, well, if I keep them too long, I'm going to start to pay city funding away. So let's get out of some. It is, though, an undeniable fact that if you look at those yen crosses, okay, we had since the start of the month, we are lower in most of the yen pairs, but we come back to like sort of mid range again, and that's been the case if you look at various levels. But if you look at what's happened in the past, you have a fast move down, and then you start to correct it again. You have a fast move down, correcting, and you can just see it over time, right? But overall, the market is not yet completely on board with the strong yen, because the other central banks are also pushing back against rate cuts, right? So that's that I think is the bigger picture. And again, I'm not going to say, I mean, yen can move and probably will move quite a bit on next week's Bank of Japan. Will those moves be decisive? That is still my big question, and I'm not so sure about it actually, that those moves will be decisive. So if they do something, it'll all depend, as I said, how they announce it. It'll depend what they announce and what they give us for later. So that will drive the yen. And then in a second leg, it's going to be, what are the Japanese big investors going to do about it? And then there will probably be your big yen move, how they react to all of this. But that's probably going to be for later. So in the meantime, I'd say until the Bank of Japan meeting, this is going to be your scenario. Get a headline, you have a dip like the GG line this morning, and then afterwards we come back to where we were before, roughly. But it's very hard to pinpoint a level onto most of those pairs, or really if you trade it, either you have a longer term view and you say like, okay, I think within now and 6 months or so the yen will be much stronger. So you have to find a way to not pay too much funding away. But otherwise, I'd say this is a very, very short term ping pong market if you want to be in any of the yen pairs.
Yeah, exactly. Agree with that. Gavin says he's got 127.40 as a bit of a level down here. That seems to be round about where it's holding. Well, maybe 30s more so. I don't see much. There's going to be a bit around 127. I'm really sort of big figure 50s on cable at the moment. That tends to be where we see most of the action happening. As you can see here, we're seeing stuff happening at 50. So yeah, 126 is going to be a number if we get down there. That was a prior support point. We had a little wander below a couple of times, then it held it again. So this one might be going back in the box at the moment, that 126, 128 box that we watched for so long. But with the BOE next week, that might get something different. Ali, I saw you had a trade about euro sterling, but you're taking it off. So I'm not sure what you were doing there, long or short on that. Let's have a look. I'll have a quick look at stocks because I was hoping he was going to be around, Ali, because I had a similar thing to you the other day, trading the S&P. I did a little short up, and I came within 2 pips of getting my TP hit in this move here. Where was it? No, I can't remember where it was. Where are we? Thursday. So yeah, overnight I came within a couple of pips of getting my TP hit. It wasn't, and then I finally got it. So I had a 20 pip TP on a trade, 2 pips, and then nearly got stopped out at the top if it had broken highs. But this is looking maybe significant now. We're talking about you want evidence of when you get a high. Well, you get a test of the high, prior high, and it holds. Okay, now we're potentially setting up a similar pattern to what we had here. This one didn't quite get to the high, but when you get a decent bit of selling pressure, market saying right now we're going to hit the rallies, be it driven by the data or whatever, it solidifies this level up here. So now sellers do have something to lean on. 80s to 90s is your zone. If you find another test up here holds maybe around the 80s again, give you more conviction to get in. Does it mean we're going to break all the way down 300 handles? Not necessarily. We still got a series of higher lows coming in, so the trend is still good. But you want to then start to see, if you're sitting up here, you want to start seeing these support levels start breaking down. And if then we break down through this one, then you got a potential trend changing move on your hands. But for now, shorts will be encouraged by this price action up here. Although, as you can see, it doesn't take much to bounce back. BTFD, folks. I'll let you work out what that says. So you're short at 41, stop at 71 on the euro sterling. You're a bit in the middle, in my opinion, mate. Obviously, your trade is your own. But you're right, whack, bang in the middle of this, whether you want to call it 20s, 70s, or even this smaller 30s, 50s zone. You're right in the middle of that one. So it's a bit of a coin toss, which way it goes from here, mate. If you're lying on the BOE, well, you might probably be out of that before we even get there. So just keep an eye on that one. No sign of the pound losing momentum. Okay, well, good luck to you, mate. You know my view, I'm still long. I did into the long down here. So I'm hoping it goes the other way. But there's no reason we can't both make money, mate. Kate, do you want to bring us your charts of wisdom?
Yeah, I'm not going to take too much time here because I'm just looking at the clock.
Oh, blimey, yeah. Sorry, mate. It's quarter past already. Didn't realise.
I just wanted to show here this tens here. We're through the 420, but there's this one here, 35.40. I think that's where it's going to go. I'm not sure this is very valid. I don't think there's a lot being looked at levels also on the tens, but here this one here, 35.40. On these afternoon's numbers, if we get even into the zone, I reckon that's going to be probably enough for the dollar to keep its big tone. And then I've been, I've been showing all those charts already a fair number of time, and really it's not changed that much. But what is interesting is if you look at if you zoom out a little bit, we are back below the daily cloud on the Aussie dollar. We are back below the daily cloud, well below the daily cloud on the Kiwi, and we are not too far away from support here, 60-65 around 65-70 in this triangle as well. Where the dollar was looking like a sell on rallies, it's again flipping around, and okay, it's typical for a market that doesn't really know what to do with it. But if we start to break below certain formations here, like below 60-80 on the Kiwi, there could be a bit of an acceleration as well. And there is Yeah, on the Swiss, we're still struggling with those levels, right? 96.30, 35 on the Euro Swiss. That's going to be your gateway to get back to those levels. Still think it's possible ahead of the S&P. And then dollar Swiss made, like the rest of the dollars, a bit of headway yesterday. For the really short term, would be funky if it holds 88.20 already, but I think we have to reckon with even 80, 87.90, okay, to hold and then push higher again. But I showed the weekly earlier in the room, and there we're still struggling, and we've been there for 1, 2, 3. This is the 4th week we are trying to enter the weekly cloud, okay? If we succeed, and that's just above 88.5, if we succeed, then that's probably going to open the way up for higher levels in the dollar Swiss. If we succeed and we hold in there next week, but then we need to get back to our shorter time frame, and again have a look at this 88, 90, 89, the figure. Okay, that's going to be the kicker. If ever it goes through here, then I think we are on our way to higher levels. But it may have to wait until the S&P next week. And really, that's about it. I think the euro dollar is 65, 65.75. And I know we are breaking a little bit of a trend line here, but it's very fragile. I'm not even going to take it out. I think it's again 65.75 here. Now that we are back below that 109, 1217, 65.75. If it goes below 65, you're probably going to need a bit of an extension to the euro dollar downside. But again, don't forget the vols are still very low. You have to manage your expectations. It's we can have this kind of move and then another kind of move and then just sit there. I mean, perhaps we have another move and then just sit there as well. So manage your expectations. And with that, back over to you, Ryan.
Thank you very much, sir. Good stuff as always. We shall call that a week, I think, folks. I hope you've had a good one. I hope you continue to have a good day today. Remember, Fridays, pips are beer pips. Don't go blowing any good work you've had this week on the last day of the week. Trade safe. Thank you for coming and supporting us here at the Flow Show. Have a wonderful weekend, everybody. We'll see you. Well, you won't see me on Monday. I'm off. I'll leave you in Kay's capable hands. I will see you Tuesday, but have a good weekend anyway, and we will see you next week. Thank you very much.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.